Sorry, I was muted, guys. Sorry, I'm live now. I'll get this thing down at one time in my life. So, anyways, welcome. Crazy times still, with all the Black Lives Matter, and man, it doesn't seem like we get a break. But anyways, with all this uncertainty and volatility, I think it's a great time to talk about your money and your investment. So that's why we're here. So today we're talking about the politics of taxation, not the politics in taxation, but of taxation, and how I feel the system's broken, and it kind of has a disincentivizing kind of platform based on our politicians. Now, this isn't a partisan Facebook Live, not left, not right, but it's just human nature. When you talk about politicians getting elected, there's hardly any politicians they'll try to get elected on a platform of we must raise taxes. A lot of people will say we have to give away things, but how are we going to pay for those things? But the problem being is that the only way to get votes is to promise things and not be fiscally responsible. And that is a broken piece of our system, which reflects in our national debt, which is now up over $25 trillion based on all this pandemic stuff. It jumped like $2 trillion, which is a number that totally unfathomable. But anyway, so taxation in your savings and investments, how do you know what's right? How to figure out what's right is to get objective, unbiased, non-solicited advice. In other words, get advice and education from a place or a source that isn't trying to sell you something. Now, granted, you can get help. But before you do, get educated. Look at both sides of everything. And I'm trying to, and in my Facebook Live, give you everything as objectively and educationally as possible, show you the numbers. So thank you for joining. Today, we're going to talk about the politics of taxation, like I said, and how you feel the direction of taxes are going to go, because it's really important to know that before you start your planning. And you'll see why. I'll show you why. I'm going to show you a little, a part of one of my live educational courses I do at a college here in town. So what do you think? Taxes going down, taxes going up? My professional opinion is inevitably taxes are going to go up. But I also want to show you what would happen to your savings and investments if nothing changed, if taxes stayed exactly the way they are. You see, there's fail-safes in place for you to have to pay more taxes in the future. And I'm going to show you that unless you make some adjustments now. And again, like I said, no politician is going to run on the platform of I'm going to raise taxes, so vote for me. But without a blatant middle-class tax hike, taxes are going to be hidden kind of in plain sight. Like the effect of inflation causes your tax to go up. What I call the widow's tax, I'll explain what the widow's tax is, and most of us will feel that. And what happened in the new Secure Act. How secure is that for your beneficiaries? And also, as a bonus, I'm going to give you some information you can take away at any time and position yourself to take your money out of your 401k, IRAs, without paying tax on it, the majority of it. Now, again, there's going to be some parameters to this. If you're 39 and you want to go and take money out of your 401k right now, you can't, because they're not designed for that. But anyone over 59 and a half, or anybody that's eligible to take money out of their qualified plans, which are 401k, IRA, 457s, and 403bs. If you're going to take money out of those after your eligible age, I'm going to show you how to do it so you don't have to pay tax or minimize the tax on those as much as possible. So that's something that could be beneficial for you in the tune of thousands of dollars, tens of thousands. And also, we're going to explain a little bit about how you know if something is truly tax-free with our tax-free test. So, I'm going to show you. I'm going to give you a little idea of something. That I'm going to share my screen here. Okay, so here we are. Now, there's a gentleman that I quote in my classes. His name is David Walker. He was the Comptroller General under the Bush and Clinton administrations. He's probably the most fiscally, in my opinion, fiscally responsible person in Washington. And he saw the red flags. He saw what was happening with our national debt, and he saw that there's a day of reckoning. And he says, regardless of what politicians tell you, any additional accumulations of debt are absent dramatic reduction in the size and the role of government. In other words, raising taxes without lowering expenses. They're basically just deferred tax increases because someday they have to be paid, right? This is what's happening with our national debt. So unless we begin to get our fiscal house in order, there's simply no other way to handle our ever-mounting debt burdens except by, which is the most important piece, doubling taxes over time. Now, this guy is a CPA superstar, the head of the General Accounting Office, advisors to Bush and Clinton during those administrations. And he said, after being completely frustrated, that unless we do something, something's going to give. And unfortunately, what we're seeing is these current administrations coming in, raising our debt ceiling and walking away, kicking the can down the road for most likely for our children and their children to have to deal with, which it could be a scary situation because right now we're at 0% interest. So where else, what other tools are there? But anyways, so I'm going to show you something that I call this is the only graph I'm going to show you, but what this graph is all the top tax brackets in our history since the temporary income tax was instituted in 1913. Good news is that it's temporary. Bad news is we're 117 years later with a temporary income tax. And you see all these spikes. And these spikes represent the top tax rates for that year. 1918, this was World War I. You see a spike in tax rates. Reason being is because they needed to fund the war. We were on a gold standard back then. We weren't borrowing money to pay for things. We were doing the right thing, raising money to pay for things. And you notice we had a lot less wars back then when we had to pay for them out of pocket. Then we had the Great Depression, and then the ensuing stock market crash. And then in 1941, we had a top tax rate in this country of 88%, 81% for anything over $5 million, which meant that was a really, really small group of people. $5 million back then in today's dollars is like 41 or something, 41 million, something around those. You get what I'm saying. Inflation in that time for $5 million was only a very few people. So any dollar you earned over 5 million, you were paying 81 cents to the government on that, and you were getting to keep 19 cents. But we're getting to the point where we were getting embroiled in World War II. And this is one of the times in our history we were close to bankrupt, like in 2008, 2009, we saw the financial crisis. So in 1942, what happened was they said, we need more money for the war. Let's just raise taxes a little bit. So that's what they did. They raised taxes from 81% up to 88%. But what they also did is they lowered that threshold from 5 million to any dollar over 200,000, right? So now they've raised the tax rates but lowered the threshold. So see a couple levers there to pull. So from 5 million down to 200,000. So that small pond before got a lot bigger. And so let me tell you a little story about a guy back then. Let's see, John Paul Getty. He was a very, very wealthy shipping guy. So let's say in 1941, he earned $6 million. And we'll just talk about the million over the 5, okay? 1941, he earned $6 million. He went to his accountant. His accountant did his taxes, slid the taxes across the desk. JP opened it up, and he saw that his bill for that 1 million over the 5 was $810,000, 81%. $810,000 he had to pay on that 1 million over the 5. So fast forward to the next year, JP goes to the same accountant. Accountant doesn't have a smile on his face this time, slides it across the desk, and JP opens it up, and he sees his jaw hits the floor. He made the same 6 million in 1941 and 1942, but his tax bill went up significantly. His tax bill went from $810,000 to $5,104,000. And he didn't make any more money. And so why do I tell that story? What does that have to do with us, the middle class, the regular people, right? What does that have to do with it? Because of this. If I was going to lend you $50,000, just an arbitrary number, there's probably 2 things you're going to want to know from me. First, when do you have to pay it back? And what is the interest rate in the terms of paying it back? Right? That's probably what everybody would want to know before they took out a loan. Think about this. When you're deferring your 401k tax due and your IRA tax due, you're not paying the tax on it. But can you tell me what the tax rate is going to be when you take it 10, 15, 20 years down the road? What if you're deferring 22% and taxes when you take the money are 40%? You're deferring 22 cents to pay a higher rate later. You're in an open-ended agreement with the government because you don't know, or nobody knows, not even any accountant in the world, nobody knows what tax rates are going to be in 5, 10, 15, 20 years from now. So you're going into a loan, and it is a loan because what you're doing is you're taking that borrowed tax money, it's not your money, investing it in the market or investing in bonds or wherever you invest your money. But you don't know your exit strategy, which is a really risky scenario if you think taxes are going up. So just think about that. Think about the exit of when you take that money. So we had the Korean War, then we had the Vietnam War, and then we had the Gulf War. You notice how it all steps down. Raised money for the Korean War, then the Vietnam War, then we have some of the lowest taxes in history when we enter in a time in our life where we have the most wars. We have Afghanistan, Iran, Iraq, North Korea, all these different wars. And every time you say war, it costs billions and billions and billions of dollars, but you don't see them raising any more money. Yeah, we have a bigger workforce, but we have the lowest taxes in our history. And this is an older graph, and we're still at 37% right now, the highest tax rate. So my question to you is, when you see all these ups and downs, right? When are we going to pay the bill? Remember, lowest tax rates in history, highest national debt ever, and we've increased it at a rate faster than we've ever increased it over our history. What happens if we bring this graph out? What happens in 5, 10, 15 years from now? Do you think taxes are going to go up? Someone have to pay the bill? Well, hold on to that thought, because I want to show you a couple things. And just for a little bit of perspective, the average tax rate, we're at 37 now, for the highest was 58.24% over the course of our history. So we're at substantially low taxes. And over the course of just about half of our history, our tax rates have been up over, 60% for half of our history. So what has changed? The quest for power, the promise of lower taxes and more entitlements. Is that how we're electing our officials, and not someone that's fiscally responsible? Folks, if you ran your household like this, you wouldn't have a house in a year. But we have a national credit card that seems to have no limit. So what are our country's biggest expenses? In 2017, 71 cents of every tax dollar went to pay for these 4 major budget items: Medicare, Medicaid, Social Security, defense, and interest on our debt. 71 cents went to that. And now approximately 96 cents of every tax dollar we take in goes to pay for those 4 things. 96 cents goes to pay for those 4 things. That leaves 4 cents on every dollar of tax revenue to pay for a few other government programs: disaster relief, the Forest Service, federal student loans, the Air Force, income assistance, child nutrition, and doesn't stop there. The CDC, FEMA, Secret Service, FAA. You can read. But what I'm saying is we have all of these government programs that are being funded by the remaining 4 cents after those 4 major things are taken care of. How can we sustain that? Well, in the near term, just by borrowing money. And where do we borrow money from? A lot of people say, well, we're going to borrow money. We borrow money from other countries. Let's just, maybe the exit for that is just to not paying back. It's about 6% of our overall national debt is foreign debt. Approximately. That means the rest of it is money that's borrowed from U.S. corporations and U.S. citizens, and borrowed from some of the entitlement funds like Social Security, Medicare. So who is that money owed to? Us, the U.S. It's owed to the people of the country. So that's a really, really important piece, because you just can't walk away from that. So think about your qualified plan. This is really what this is made from on a macro level down to your level. What does this mean for you? If the IRS is letting you use their money to invest in the market, well, you'll pay them back at a rate that may be different in future years. Just remember, there's 3 things you want to remember here. What tax bracket are you going to be in retirement? Nobody knows that. Nobody knows that. But if you think after listening to this or getting more information out there that you think taxes are going to go up, just think about what you're doing if you're deferring 20 cents on every dollar to pay 40 cents on every dollar when you take the money out. Secondly, what deductions we have when you take the money? When we buy our house, we usually want to have it paid off by the time we retire. Usually our children, our exemptions have moved out, which the personal exemptions are gone, but the exemptions are moved out. So we lose those deductions as we get closer to retirement, and bam, time to start taking your money out of your 401k or your IRA, and you can't deduct anything. Everything's already been deducted. So now you're paying 100% of every dollar that comes out of your 401k, you're paying income tax on, or your IRA. So think about what deductions you're going to have when you have the money. Great idea is maybe open up a small business. And we can definitely advise you on that stuff. I'm really, really focused around this part of retirement planning and investment planning for younger folks. Is what's the exit on this? All right, how much are we gonna pay? How much do we have to pay our partner, Uncle Sam? We really want to define that and set a course for that. And what is your exit strategy? Like I just said, how are you taking that money, and how much of that are you going to be able to keep for yourself? And again, taxable, meaning not just now in your life, but if you're passing money on, how is it going to be taxed? So things to think about, things we take into account when we're doing our retirement planning or doing your investment planning, that we take into all those things into account and make sure you're aware of every angle. So I told you we'll talk a little bit about a couple things, the widow's tax, and the other thing was, I'm just going to give you a little bit of the story or scenario on the Secure Act. The widow's tax for married folks. Think about this, folks. Unless, and I don't mean to sound facetious or sarcastic here, unless you both die, two married people, in a car accident at the same time, one of you is going to lose half of the tax deduction. Because for argument's sake, if the married filing jointly, standard tax deduction is $24,000, your spouse is no longer there. Your new tax deduction is $12,000, which means, so $12,008, something like that, they've adjusted it. So what that means is that when you take money out of the IRA or the money you inherited, say your husband or your wife's IRA, they passed, you don't get to deduct as much money now, and you have to pay more tax on that. So your tax bill goes up by default. So if nothing ever happened, even taxes never went up, when someone passes, your tax bill goes up by default. So keep that in mind when you're thinking about how you're planning for your retirement, how much money you want to save. So the Secure Act does a couple good things. You don't have to take your RMDs, your beginning date, until age 72 from 70 and a half. There was a few changes and nuances with the CARES Act. I'm not going to get into that. I did that before. This is just if everything was cool out there and we weren't going through all this craziness, you don't have to start taking your 401k or IRA money till age 72, which means that if you didn't need it, you can leave it in there, let it grow. You can continue to contribute to your IRA, but what's most important is in the Secure Act, they've gotten rid of the stretch. So what that means is you have a 401k or IRA, you die, it goes to your wife or husband. They pass away, then it goes to their next of kin. Let's just say it's their child. Let's say you have $1 million that goes to your daughter, who is a successful person who's earning $150,000 a year. She has to deplete that $1 million or take it out of that account within 10 years. So let's just say she had $1 million, 10 years. She was taking 100 grand out every year. So she could reach that goal of having that account to zero and taken out and tax paid within the 10-year period. But she's earning $150,000 at her job. She's also taking another $100,000 that she inherited, which means she has $250,000 of income, puts her in the highest tax bracket. She's paying the highest amount of tax on her inheritance. So when I say, do you think taxes will go up? Taxes already have gone up. And they're doing it. They're not going to do it on a blatant front page ad on the Wall Street Journal or Investors Business Daily or whatever you read. They're going to do it and hide it in plain sight like they're doing now. That means 37% of that money that she inherited is going to the government. Boom. Before the Secure Act, she could stretch that out and amortize the amount she has to take over the course of her lifetime. So she was only 35. I think her lifetime on the IRS uniform tables is like 86. So she would be able to split that up over that many years. That's gone. Secure Act is now the Unsecure Act when it comes to paying taxes on what you inherit. So I'm going to stop sharing my screen and I'm going to come back to me. So hopefully you get a little bit of an idea of taxation and how it can affect you. I had a thing on inflation that I wanted to show you that I didn't put up, but I'm going to explain it to you. So let's say in 2020, you retire and you plan on taking $75,000 per year. And you all know how inflation works. A loaf of bread back in 1950, I don't know, was 25 cents. Now it's like $4.50 because of inflation. The bread isn't worth anymore. It just takes more dollars because the dollars aren't worth as much as they were. So think about that. So you need $75,000 a year in retirement to buy the goods and services you need to retire and live the life you want to live. In 10 years, you're going to need over $107,000 to buy the same goods and services that $75,000 bought you 10 years earlier. So what does that mean? If you're only taking $75,000 from your 401k, you're in you're married, you're in a 12% tax bracket. 10 years later, taxes haven't done anything, haven't gone up, gone down, nothing. 10 years later, you need to take out 107 to buy the same goods and services that you needed 10 years ago that were worth 75,000. You follow me? Things cost more as the years progress. But because of that, taxes did nothing. You're now in a 22% tax bracket because you took out 107 versus just the 75. You see how that works? So inflation is a friend of the government. Inflation is a friend. They don't want it to be too high. They don't want it to be too low, but they wanted, they wanted to have it so at least they can lower their debt. If you have a 3% inflation rate and Social Security is only adjusting at 1.65 on average per year, you see what's happening? That they're lowering the benefit amount for everybody over the course of time through inflation. So another thing to think about, taxes do nothing. You will be affected. You will have to pay more tax because of inflation. So that's all I have for you today. Taxes are a big thing for me, and they can get really complex, but we can help you through whether you have an estate issue. In Massachusetts, we have a $1 million state tax threshold, which is super, super low. Federally, it's 11 million per person. A lot of people aren't getting there, but it depends on the state you live in. That could be an issue. If something is tax-free, there's two things it has to pass, and it could be, there's two things. First of all, there has to be a tax-free investment, has to be free from capital gains, federal tax, and state tax. Those three, which there are tax-free investments out there like municipal bonds, if you invest in the ones that are where you live. But the second test for something to be truly tax-free is this. It has to not be included on the provisional income calculation against your Social Security. It can't be included on that. Municipal bonds, the earnings on municipal bonds are added on your provisional income calculation. I haven't gone through this on Social Security, but what that means is you have to pay more back from your Social Security based on the gains in a municipal bond. They are not truly tax-free. They are tax advantage, but not truly tax-free. Folks, there are only two things that are truly tax-free, and maybe a third. The first thing is a Roth. If you want to convert your money from if you think taxes are going up and you want to convert from an IRA to a Roth IRA, the government took off the lid. You can convert as much as you want. Doesn't matter how much money you make. There are no parameters. You got $50 million you want to convert to from an IRA to a Roth, you can. If you are still saving money and you want to open a Roth, we can open a Roth for you and help you with the investments inside the Roth if that's what you like. I can tell you what the parameters are. I'm not going to do it now. So open a Roth or convert. Two different things. But remember, if you think taxes are going up, it would make sense to pay the low tax rate now to avoid a tax increase later and get all your money tax-free at that point. The second thing that's in our tax code, which is code 7702, it has to do with life insurance. Now, life insurance isn't just about death benefit. This isn't your grandparents' life insurance that I'm talking about. I'm talking about how the wealthy use life insurance to minimize their taxes to pennies on the dollar, and also how they leverage life insurance contracts for other things during life. And I'm going to talk about that next time. We're going to talk about the private reserve strategy and how the wealthy use life insurance contracts. That's the only other tax-free investment. So no capital gains, doesn't go into provisional income. And a third thing that I'm going to add to this is that a truly tax-free investment is tax-free when it passes to your beneficiaries. That's pretty important piece. Now, some people argue that your house could be tax-free investment. Yes, I covered mortgages in my last Facebook Live last week. You want to look at that one and see how much you actually earn on a house. And yeah, if you're under the capital gains threshold, it is tax-free. So it can be, depending on who you are, what kind of house you have, and how rich you are. It can be a tax-free investment also. So if you want any information, by all means, just message me on Facebook. Ask me any questions. I don't mind. I don't mind helping people out. You don't have to be a client of mine. You can be a friend of family. You can be referred to from one of my clients. Ask me anything on Facebook. Message me, and we can start a dialogue on my email or talk on the phone. Doesn't matter. If you're thinking about, okay, what is the difference if I keep my money in an IRA or convert to a Roth IRA? I can run tax clarity analysis for you to show you the before and after. Because you're going to end up, if you convert, you have to pay tax now, but what does that mean in the long term? And I can show you that and give you real clarity on, okay, should I do this or shouldn't I do this? And also I can show you what happens if taxes go up. So here's your money. It's in your 401k. Taxes go up 10%. What happens to your spendable income? Taxes go up 20. Taxes double. What happens to how much money you're going to pay to the government over the course of the rest of your life? I can show you all that stuff, and I do that at no cost. So hey, if I can save you $100,000 and you don't have to write a check to me, why wouldn't you, right? So message me on Facebook on that. Another thing is this. Think about, through tax planning, if you were scheduled to pay 30% taxes over the course of your lifetime, say in the state of Massachusetts, you're at a 24 federal and a 6% for the state, or 5.125 for the state. And we were able to adjust your plan, so we bring you from a 22% tax bracket down to a 12. You just made a 10% return on your money, and you didn't have to risk anything. To me, that seems like it's at least something to explore. And again, no cost, no obligation. Reach out to me. You can reach out to me through my website, which I'll put up here. My website is right here. And the contact us page. You can reach me at my, let's see if I have, my email is right here. I'm just going to put this up for you. Check the spelling. I'm going to show. So this is my email. Email me directly if you want and ask me any questions, or you can call. So you can give me a shout at any time at 978-406-9137. That's our office number. And you can call me, and if I'm there, I'll patch through. If not, leave a message and I'll give you a shout back. I have my receptionist will answer it for us. So I think that's all I got for you guys for this time. Yeah, so next week, go onto the Facebook page, and if you like what you see, then do this. I can't say it out loud. Compliance. But go ahead and do that. That way, every time we have a Facebook Live, you'll know what's coming. And I post a bunch of stuff about savings, investments, retirement. Non-intrusive, non-salesy. Just hopefully, it's my goal for everybody to be educated. So we'll talk about income for life, how the wealthy use life insurance, a private reserve strategy. Really, really powerful stuff. Don't miss that one. I'm telling you, it changed my life, and you know, hopefully it'll take you a little bit of time to wrap your head around it, but when you do, it's kind of cool. So just go to the page, and so you won't miss the announcement, and I will see you guys next time. Take care. Bye now.